Hey guys, welcome back to the channel. So much is going on, so much uncertainty, and changes are coming down the pipeline. And on November 14th, OSFI, Canada's bank regulator, quietly dropped a follow-up clarification to mortgage rule changes coming in 2026. And some say it'll actually affect investors, and that investor purchasing may actually cool down. And most people completely miss the update. But not you, because today I'm actually breaking it all down in plain English. So you know exactly what's changing, who ultimately it affects, and how it's going to reshape real estate across Canada. I'm Linda, one of the Ragona Sisters, and this is your real estate reality check. Make sure to like, share, and subscribe because what I'm about to tell you might be something your mortgage agent hasn't mentioned to you yet. So let's back up for a second, just for context. Back in September, OSFI released its final update on how Canadian banks must treat different types of mortgage risk. And I mentioned this in a previous video. Just to recap of one of the big changes, a brand new category called income producing residential real estate, also known as IPRRE. So basically, if a mortgage depends mostly on rental income for the property itself, it's now classified as high risk. Think investment condos, rental properties, or anything where the bank says, hey, if the tenant leaves, can you still pay your loan? If the answer is no, that's the classification of IPRRE. It doesn't sound dramatic, does it? But here's what it really means. Banks will have to set aside more money for these types of mortgages. So when a loan is more expensive to hold, guess what happens? Rates may go up, terms might get tighter, and lending could slow down in that category. But here's where it gets even juicier. On November 14th, OSFI classified how they'll determine which loans are considered income dependent. And here's the test. If more than 50% of the income used to qualify for the mortgage comes from the property's own rental income, it may be classified as income producing residential real estate. Simple as that. So let me give you a basic example here. So let's just say you want to buy, a duplex. You earn about $90,000 a year, and the mortgage application includes about $2,000 a month in rental income to help you qualify. If that rental income makes up, more than half of that total income being used to service the loan, that mortgage might now be treated as higher risk under OSFI's rules. And it gets even more complicated if the buyer's job income is lower or if they're self-employed with variable income. This change affects how banks carry the loan, not how you apply for it. So here's where people get confused. OSFI is not changing borrower qualification rules. Your down payment, your stress test, your documents, those still follow the B20 underwriting guidelines. What has changed is the back end, the math on how the banks look at it. If the bank lends to someone with heavy rental income reliance, they may now have to put more capital aside. And that could make these loans less attractive. So the bank might start saying, yeah, we'll still lend you, but with a higher rate or maybe a bigger down payment, or you might need additional documentation. Those are some examples. That's the real impact here. We're not talking about major crisis here, but we are talking about a structural change in how banks evaluate and price risk. And when the banks adjust their pricing models, even slightly, that all trickles down to every buyer, seller, and of course the investor. So don't think of this as just a behind the scenes regulatory update. Think of it more like a preview of how financing is about to evolve. It's these kinds of seemingly small shifts that shape who can afford what and when. So does this mean investors are doomed? Or is this just smart risk management? And let's get into that. This isn't about shutting down investing. It's more about sorting the serious buyers from the over-leveraged speculators. Believe it or not, back in 2021 and 2022, investors flooded the pre-construction market. According to industry estimates, actually some projects saw 70% of units being sold to investors. That's not healthy, guys. When the market turned, many of those investors, they couldn't close. And suddenly we had canceled deals, fire sales, and builders in panic mode. And guess who was left holding the damages? It was the buyer that signed the contract. So OSFI is moving to isolate income-dependent investor mortgages. So it's actually a gift to people who live in their homes, because when investors and homeowners get lumped together, everyone pays more. But when risk gets isolated, banks can actually offer better deals to buyers who are less risky. And let's be real, someone buying a place to live in is usually less risky than someone stretching to buy door number 4. This is also a reminder of how crucial lending policy is in shaping the real estate market. We talk about supply, we talk about pricing and demand, but financing, that's the lifeblood of the entire system. If you change how lending works, you actually change who can play in it and how. So even though this update is technical, it's a ripple effect and it's very real. Now let's be crystal clear here. This change does not mean prices will fall overnight. That's not what I'm saying. But it does mean investor appetite might cool down, especially in places like the Greater Toronto Area where cap rates are already razor thin and cash flow is very tight. Investors will have to do more math and bring more equity to the table. That makes it easier for families and first-time homebuyers to compete. And that's why this change matters so much. Now let's look at what it means for buyers and sellers and investors over the next 12 to 18 months. If you're buying a home to live in, you're likely to benefit here. Less investor competition, more sensible pricing, and banks that are more willing to back you than an investor buyer. If you're selling, it's a shift in audience. You'll need to work with agents who can reframe your property for end user appeal. Investors might still be in the game, but only the serious ones. And if you're an investor, you're going to need a better plan than you had before, because cash flow is king again. You'll need more equity, stronger tenants, and an exit strategy that doesn't depend on infinite appreciation. Those days are gone. So talk to your mortgage advisor early. Review your financing scenarios is a good idea, and be ready to adapt. And here's the big idea. This change makes the market much healthier. It reduces hidden risk, and it pushes banks to lend smarter, and it gives end user buyers a better shot. So if you're hearing all of this and thinking, how does this affect my deal, my refi, or even my timeline? Let's talk. Or if you have any questions about the Greater Toronto Area real estate market, we would love to hear from you. We'll actually walk you through your options and help you plan for what's ahead. And if this breakdown helped at all, hit that subscribe button because it helps get this video out to more people. Thank you so much for watching, and we'll see you in the next one. Bye for now.